In this video, we're going to cover an easy way to pay off a 30-year mortgage in 10 or 12 years without even thinking about it. Hey guys, it's Mark Cullimore here with Geneva Financial. We release a ton of content to help you better understand your mortgage options and get you the results you're looking for faster. If you're new to my content, then make sure that you push the subscribe button and check the links attached to this video if you want to connect or explore these ideas further, or for that matter, go over any other loan scenarios that you have in mind. As always, there's no cost or obligation just to connect. Traditional mortgages, they employ a math equation called amortization, where the banks collect interest first, then have you pay off the principal balance in ever-increasing proportions until the contract runs its course and you finally get to become mortgage-free. Strategies and methods used to lessen the interest expense in the past have been having borrowers tighten their household budget in order to make extra principal payments, refinancing to a shorter term, downsizing, understanding and utilizing mortgage points, snowballing the higher interest debt payments into their mortgage payments, or renting out unused living space to tenants. All of these are great suggestions. They're all doable, but some of them require some pretty significant lifestyle changes. The HomeSelect mortgage program from Geneva Financial is a more borrower-friendly innovation. The formula flips the order in which principal and interest are paid, front-loading the payment of the loan principal first. This significant formula tweak could be one of the greatest breakthroughs in personal finance in the mortgage industry in our lifetimes. It has the power to make your dream of mortgage-free homeownership much more realistic. Let's look at some of the benefits that are available. This is an offset mortgage, and it works as a fully secured checking account that allows borrowers the freedom to use your regular income to reduce your mortgage interest. All deposits are applied directly to the loan principal, offsetting the outstanding daily balance in which the interest is computed. Access to deposited funds are provided 24/7 through ATM debit cards, check writing, online bill pay, and ACH, which is automated clearinghouse transferring. Home financing and personal banking are combined into one fluid offset account. They are inextricably connected. The product is designed for new home purchases as well as mortgage refinances. It's available for primary homes, primary residences, second homes, as well as investment properties. This is an equity loan where the banking features allow the borrower to access some of the equity dollars in their home without having to negotiate with the bank, without having to go through an appraisal or a refinance. That's just typically not allowed with most first lien products. Point 8, it requires good credit, and it's most suitable for cash flow positive households. And finally, borrowers can pay off their homes sooner, they can build equity faster, and they can free up money that can be used to build wealth and redirect to higher interest earning opportunities. Probably best to get a picture of this, a flavor of this, by plugging in a real scenario. This is a scenario I worked on last week. The home value average in the United States is around $300,000 right now, making the loan balance, the maximum loan balance that we could do, around 80% of that for this mortgage. So for comparison, I'm putting a 30-year fixed at 4% against the HomeSelect all-in-one loan. At 4%, that would work out to be $1,146 per month. We have to make assumptions about deposits whenever we put these scenarios in, and so every single one of these loan scenarios is one-off. We would have to put in your income and your household income and do all of those calculations. But in this scenario, we're using $108,000 that the husband is putting in about $60,000 per year, the wife about $48,000 per year, and so the household income is $108,000, right around $9,000 per month. We also have to make some conclusions about withdrawals, and so in their scenario, as we plugged in the numbers, we saw that they had about 15% of their net earnings left over at the end of the month. That translated into about $1,350. So as we do the comparison and let the simulators run their course, what we see is that the all-in-one loan, if followed that program precisely, it would pay out, it would take $337,000 to pay that loan balance off, as compared to the comparison loan, the 30-year fix of $412,000. The years to pay it off would be 11.3 years, and the interest saved would be $75,000 and change, about $75,400. If we go down to the bottom of the page, the principal paid is on both scenarios is $240,000. But look at the principal reduction rate. With following the HomeSelect all-in-one loan, it's 8.9% per year as compared to 3.3% per year. We already talked about the interest, $97,000 versus $172,000, basically $500. The fourth point here, the interest as a percentage of principal, that 40% means that for every dollar that you borrow, you pay back $1.40, as compared to the comparison loan, the 30-year fix, you pay back $1.72. So this is a equity line, and so it has a margin plus an index. It is not based on prime. It's based on the London Interbank Offered Rate, the LIBOR. We would have to have some discussion about that, but you can see that even with the 6.4% compared to the 4%, that you can still save $75,000 in interest. That's a lot on a $240,000 loan balance. Graphically, it looks like this. The blue line is the credit limit, the maximum that you could pull out. The gray line is the comparison loan, the 30-year fix, and that just follows the expected arc of starting off with mostly interest paid and a little bit of principal, all the way through the entire process to the end where you're basically making almost all principal and very little interest over the 30 years. But look at that green line. The green line is the all-in-one loan, the HomeSelect mortgage. That just drops off like crazy. As soon as those dollars are activated, that normally just sit in your checking account or your savings account, not doing anything, but because they're activated and they're used to pay your principal balance down, you can see that it just drops down into 11.3 years. And in the event that you want to have to come up and tap into that equity for any reason, you can see the gap between the green and the blue lines. You can pull out cash for medical expenses, for home improvement, for vehicle, for weddings. I have one of those coming up. For your business, there's always the flexibility of tapping into that if you need it. And if you don't, then you can see that the home is paid off faster than just about anything else you can do. This isn't for everyone. It's for people that, like I said, have great credit and have some money left over every month. But it might be better than the path that you're currently on. I think if you're considering something like this and you'd like to see what your numbers look like, we should set up a strategy session and go through that. And we can see if you're on a great path. I'll be the first to tell you, keep on trucking, keep on doing what you're doing. However, you might be pleasantly surprised by this option and maybe some other options that we have out there. My office number and text number right there, 480-329-5259. You can also email me, mcullimore@genevafi.net. Look forward to talking to you guys soon. Thank you so much for your time. Have a fantastic day. Bye for now.